So I think that's the approach of how to add value as a VC, not being an asshole about it, but being helpful and helping them do that. Because the fact of the matter is that most startups will fail regardless of how much the VC will throw in support or not.
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave.
There are also top 10 investor, I would say, control rights that are linked to equity outcomes that are quite key for you to be aware of. The first is the right to information. A lot of investors may not have the right to understand or hear updates from the company. So for example, recently there is a deal, there's a secondary transaction that's available for people to buy secondary shares in OpenAI. So OpenAI has a shareholder that wants to sell. Then there's a fund manager that's willing to structure an SPV. And then they are working with another entity in Southeast Asia. And then they're distributing this to the network, right? So several layers. These people buying secondaries OpenAI are obviously excited about the opportunity to do that. My wife and I discussed it and we're like, wow, OpenAI is losing a lot of money. So buying at a premium the current round doesn't seem like a good idea. But one of the key concerns we had was that there isn't a right to information, no ability for us to access the financial reports, other key business updates. Because again, a shareholder is selling to multiple vehicles, all that stuff. So right to information is key to decide. Secondly, of course, is the right to vote. For example, you may want to approve a merger or change the board. Shareholder classes have a right to vote. We mentioned anti-dilution, a preference in dividends. For example, a lot of companies in Southeast Asia may stay private. So do you have the ability to receive dividends? Liquidation preferences, we talked about it in terms of liquidity waterfall. Next, the right of first refusal. If new investors are included, you have the chance to say, hey, I want to buy these shares first. Drag along rights are key because when a majority shareholder wants the company to sell, minority shareholders can veto the deal. Drag along right is basically saying if the majority shareholder says yes, everybody has to come along. Because you can't sell 80% of the company, right? You need to sell 100% of the company to a new entity. Tag along rights is a way for minority shareholders to ride if a majority shareholder sells their shares. Pro rata preemptive rights are abilities for them to buy up more ownership or keep them. And lastly, of course, is conversion rights. Are you allowed to convert your shares into the target class of shares before an IPO or exit? These are all common clauses for you to be aware of. There are multiple tiers of equity shares, and pari passu is a way of allocating. That may not necessarily be the case. Every shareholder that comes in may renegotiate how that is done. So I wouldn't say there's a market standard. In America, where there's more competition by capital for startup founders, the legal documents tend to be more market normal or market standard because found VCs who are highly deviated from that tend to get shamed or blacklisted by founder syndicates, unions, or networks in Silicon Valley. But I would say that in emerging markets, there's much more variation. It tends to be renegotiated every round. It doesn't matter where it is in the company, it tends to be renegotiated every round. In practice, when there are conflicts of interest between founders and investors, such as whether to accept dilution in new funding round, how do you balance to determine what is in the best interest of the company? That is a common debate, and that happens for public companies as well. Generally, it'll be a vote by the board of directors, followed by potential vetoes by major shareholders that have negotiated that. So I can tell you that my wife made an angel investment in one company. I was not a fan of the investment, but so be it. 2 years down the road, the founders decided to make a pay to play. So basically what they said was that we need more money and we swear that we're doing well. And if you give us money, you will get to top up and get bonus shares. But if you don't participate, you will get significantly diluted more than proportional, right? Which was a very heavy-handed way to approach minority shareholders because of the lack of transparency about their prior financial information, but also some perspective that I didn't really feel like the company was going to continue doing well. And because of the way they were treating minority shareholders badly, I was like, this makes no sense to put more money to buy a lot of bonus shares at the expense of minority shareholders. But in the next round, we as minority shareholders will continue to be taken advantage of again, right? So if this is how they treat minority shareholders, let's just write off this investment. I've said the way they currently treat minority shareholders is suboptimal even tactically, because it reveals to future shareholders that you do not respect their shareholder interests. So they're going to be much more draconian in how they negotiate future agreements with you. So I've told them that it's like counterproductive to do this. You could have just done this very simply. But then again, as a minority shareholder, I don't even have the right to speak with the founder dramatically either. So there's that. How should founders handle potential conflicts of interest between their responsibilities as directors and their obligations to investors and shareholders? Are there scenarios that you've seen where these duties have conflicted, and what might those have been? I think there are multiple conflicts of interest, because I think when you start the company, and I myself was a founder, when you start a company, you are just yourself and your co-founders. So there's easy 100% alignment, right? Where the board is the 3 co-founders, the company is 3 co-founders, and our interests as shareholders are the 3 co-founders, right? But obviously that changes over time. I think when times are good, it's easy to balance it because it's dividing the spoils. And I think that the board has an obligation to represent shareholders, but the board actually primarily represents majority shareholders. Founders have to be the most thoughtful for all of them. I think that's where I think VCs and institutional funds have more power, because they have the ability to go to court, for example, to seek redress or compensation if they're cut out. So I think there's some sort of checks and balances at all levels to make sure it all works out when things go well. Obviously, there's lots of scenarios where things have not gone. So for example, in FTX, it technically had a board by Sam Bankman-Fried, but SBF called it a rubber stamp committee where he would just send them a DocuSign and they'll just automatically sign stuff that they had. So it wasn't necessarily seen by him as an actual control entity. Shareholders could potentially have done that due diligence to say, does this board actually want to represent my requirements and my interests as well? So not necessarily always easy. So a VC investment portfolio, about 90% will fail. I think that there is maybe 3 tranches. I would say the first tranche, of course, are companies that are doing well already. The second tranche would be companies that could potentially do if they have the right support. And then the third, of course, is companies that you judge are less likely to be able to turn it around despite support. Most VCs would try to support tier 1, but they might find that the founders don't even need their help. And I think VCs spend quite a bit, maybe with tranche 2, I would say, where they feel like there's still a chance of pulling a rabbit out of the hat. And then they tend to write off the tranche 3. That being said, of course, the way they have already compensated for that is, again, economically, the model does not require tranche 3 to succeed. So I think what the good thing about institutional VCs that are professional about it is that when the founder fails in tranche 3, they don't make it personal. They are thoughtful, they're supportive of the wind down process, and try to make sure that it's a graceful failure where the founder lands on their own 2 feet in a new company or a new job or a new profession. So I think that's the approach of how to add value as a VC, not being an asshole about it, but being helpful and helping them do that. Because the fact of the matter is that most startups will fail regardless of how much the VC will throw in support or not. Convertible debt is coming back. Price equity rounds, like I said, historically were used for almost all investments like 20 or 30 years ago. A safe note has only emerged over the past 15 years as a standard norm for early stage startups. But convertible debt is coming back as a norm for later stage startups. So a safe note is totally inappropriate for a middle or growth stage or late stage startup. Let's say the company has 20 million valuation or 50 million valuation or 200 million valuation. They may say something like, I need some capital in the short term to make a decision, but it's hard for me to tell what the price for the next round is. So I want to use a convertible note structure to absorb some capital and then say, if you come in now and give me $10 million, for example, then you get a 20% discount on the next round in 1 year's time. So you get 20% bonus shares for coming in 1 year early. Convertible notes are coming back in these tough times because for family offices, for growth equity funds, one of the benefits of a convertible note is that for as long as the convertible note is outstanding for the next 1 to 2 years or 3 years, they are recognized as debt. And so if the company fails the next 1 to 2 years and the company only sells for $20 million or $30 million, because you're a debt, you're able to extract your money first. You're taking on much less risk for this short time period, but gives you that bonus upside. Again, to share the rewards when they start resuming that growth trajectory. So I would say convertible debt financing is more common in emerging markets So I think we see this resurgence in China as well as in emerging markets because, again, they feel like a lot of the startups may not necessarily be able to grow into unicorn. And so they want to use debt. They want to be able to extract the money as collateral. So it caps the downside, but lets them keep the upside as well. So yeah, I think in general, a founder would always prefer to do a price round or safe note. In general, doing a convertible debt is normally a sign that it's not preferred for them. So I think founders tend to lose majority economic control and therefore also majority board control roughly around, I'll say Series A or Series B on average in the US, and maybe around Series A for Southeast Asia because of the Southeast Asia, they tend to take a larger bite of your company to compensate for the higher risk of your company. So I think once you lose majority, then you lose that control, right? And then founders don't really necessarily have a veto right because they normally control common stock, which is the most basic form of stock, which does have voting rights. To some extent, may not necessarily have any veto rights available to it. So that's number two. The third, of course, is that technically as management, they do have a veto in the sense they can choose not to do something. For example, if a VC says you must sell the company, you vote to sell the company, the founder can be like, I don't want to do it. And then there can be a dispute. And then that would be effectively a veto by the founder not executing the decision by the shareholders or by the board of directors. So that can be quite a messy piece. So I think a lot of boards obviously try to make sure that the founders are bought in, or at least one of the founders are bought in. The classic story of a lot of them is like one founder votes. We saw that for OpenAI. So the founders were there. It was a nonprofit technically. The majority voted to kick out Sam Altman, but some people were not aware, so they were not part of quorum, or some of them voted against it. Boards don't really want to run a company, so they only want to meet every quarter, and all they want to hear is this company is doing really well. Which is like a tranche one, right? It's like I came from my quarterly board meeting, and it's like, wow, your company grew 2x over the past 3 months. Good job. By the end of this year, you're going to grow 10 times. So that's all they want to hear. And then everybody logs off and says, then they go back home and they tell the shareholders, wow, this company is going to grow 10x this year. That's all they want to do. What they don't really want to do is get into very deep technical. Every shareholder just wants the milk. Not everybody wants to be a board director. But of course, as a board director, you have higher responsibility. You have more control rights. You have more voting rights. By compensation for that, you need to do more work, right?
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.